There are four main tools you need to understand as a trader which will enhance your market analysis. And because you guys are experienced traders, you guys will not just get the base level understanding. We'll be going in depth into all the mechanics of how these models actually work and how we can actually maximize their potential. I'll also give you guys a way to apply all this knowledge with a checklist you guys will receive at the end of the video. There are a few prerequisites, which are our trading previous day high and low strategy, and as well as focusing on mastering the daily time frame. These are very good fundamental videos. So after this video, guys, you guys get the full lecture, so there are no more confusions when you're trading. First one is our FVG, fair value gap. This will be defined as price jumps caused by imbalanced buying and selling pressure at a given period in the market. The market will seek this area to allow fair value to both market participants. This is an example of our bullish fair value gap, where we can then draw it from the first wick high to the third wick high, and we can then see that there is a lack of participation from our sellers. And our bearish fair value gap would be a lack of participation from our buyers. Now, this is not just an understanding of this three-stick candle pattern. We'll be going in depth into the fundamentals behind this, okay? As you can see, for our sellers, in a scenario where we don't have a fair value gap, you'll see that the first wick and third wick align. Okay, you notice that in a bullish fair value gap, we actually have market structure that is heavily biased towards our buyers. As you can see, we have very short retracements with every single new candle opening. As you can see, our first candle opens, creates the low of that session, creates the high, and then closes. Okay, the second candle opens at that point, closes. Okay, but these are very small, minimal retracements. Okay, as you can even see here, they are only small bearish candles that emanate these little wicks over here. Okay, so we can just understand that there's obviously going to be a huge displacement in price action that later on has to be filled to allow fair value to also these sellers that are part of this global market that we do trade. And in the case of us not having a fair value gap, as you can see, this is defined as efficient price action. We are led with a bit of bullishness and then also led with a bit of bearishness, okay, allowing those two bias ideas that we have in the market. Some might see sells and some also might see buys. Okay, this is obviously the buyers at the lows and the sellers are at the highs. Now with this gap, we can divide it into quarters, where we have our low band area, which goes from our low band to our equilibrium and will contain our Q1, and here are the levels of these areas. Okay, and here is the upper band, which is from our Q2 and equilibrium area. Okay, if you're trading the lower time frame, you want price to close within this upper band, because this will allow price to then quickly push off of this level and impulse the upside. If price tends to close within your lower band, you should realize that there's a high chance of price consolidating for a while before it even does make a push. And even if it does start to impulse, it wouldn't be as volatile if price were actually to be in your upper band. This is just derived from the normal market momentum. You'd want to see a very short retracement in a very impulsive market. Now, this is an example of us price disrespecting our area. However, this does not become completely useless, because then price will then use it sometimes to actually rebalance from it again. Now, this is also extremely important. We cannot allow ourselves as experienced traders to see the fair value gap as a candlestick pattern, or else we would just fall into the trap of basic manipulations. So we want to actually give our fair value gaps context, and this is derived from looking for liquidation / sweeps before the FVG is actually formed. As you can see, this can also be derived by just seeing a simple candle range sweep, or even simply equal highs or equal lows, our basic liquidation models. However, these give rise to that impulsiveness that is later on experienced in the market. And this will then also be shown by a formation of a fair value gap, where price to also continue this impulsiveness. It will then rebalance from that liquidation fair value gap and then push up impulsively. And as you can see in this example, price closes above, which allows to rise up quite quickly. Now, this is scenarios where we also want to understand that there are good and bad setups. This is one of them where we should actually look to avoid this. Now, in terms of priority in the market, price heavily tends to follow liquidity before it even considers bouncing off a fair value gap. So before even bouncing off of an FVG. So understand, if you are selling, you want to make sure that you are above the sell side liquidity, which will be trend lines above you, okay? And if you are buying, you want to make sure that you're below any sort of support area liquidity. This at least allows you to be in line with the liquidity that price is creating. As you can see in this example, we're actually below the seller's liquidity from this trend line, and then obviously price will tend towards that instead. That's actually a mistake that you guys want to fall into. As you can see, breaking it into our quarters, we can see as price closes in our upper band, it still gives very good rise to monumentous moves. So for our scalpers, you guys can be fully able to even trade that one bullish candle, and even after that, it gives you rise to even more moves after this, okay, with great impulsiveness. And you can see we also have it in context with a liquidity sweep. One of our candle range before previous candle high, previous candle low point is then swept, and also of these general equal low points that is then swept and then gives rise to this impulsiveness. Now this is how you guys are tending towards from beginner to experience in how you are creating your market thesis for the exact day. And here are two examples of us seeing this, where price comes to our upper band once again and gives a very strong push. However, once price closes within that upper band, okay, we then see it starts to move off very slowly, okay. And also understand that these lower bands and upper bands will then change given that you're trading a bearish FA value gap. You'd want price to be within your low band for any pulse move, and for a slow move, price will have to be in your upper band. And we can even see with the upper band movement, price does once again seek above even higher. So even if you entered around here, you might have been incurring a loss by this major spike, okay. So it would be best for you to watch price to be within that even better 0.25 level, your Q1. Now our next tool would be our order blocks. However, the order block definition is order blocks are supply and demand zones where large market participants place large orders. However, since a large volume order can cause a sharp price change, it is then divided into smaller order blocks, which are then executed as the liquidity of the counter orders accumulates. This strategy allows institutional traders such as central banks and other financial institutions or other hedge funds to fully fulfill a large order without significantly affecting price. Now you should also understand that your order blocks are not just the last up candle before a sell move. This truly holds no valuable truth when you're trading your market. Instead, it's better to understand that institutions sometimes have obligations to sell on a specific day. However, for them to sell, they would need someone to actually buy at that high price, which is why they would firstly push up the market, and then the rest of that bullish quarter would be filled out by retailers who just want to get in on the formal buy of the day. Once they realize that there are enough people to actually buy this asset at a higher price for them, they then sell that and then keep on dropping down the market. However, that initial buy that they place is now currently in drawdown. What they'll then do is allow price to rebalance, close off that initial buy movement, and then drop price once again to fill out the bearish quarter for that specific day. And now this is a logical approach that you can apply to your order blocks. If they want to buy up for the day, they'll quickly put in a sell contract to firstly incite the former sellers into the market, which then allow them to buy a price at a discounted price. Once they reach this area, they will then push up the market once again. However, their initial sell is now in drawdown. So what they then allow is for price to rebalance and actually close off their initial sell at break even, and then allow price to continue to the upside. And us as experienced traders, we can then take advantage of that movement and then profit off of the market. As you can see right here, they quickly open up, allow price to move up, selling down the market. They then close their first buy of the day at break even, and then allow price to push down lower. Now here's an example of this, making main focus of our candle opening of that order block. As you can see, price frequently firstly comes to this area and then pushes down, and then once again you can see this holds very high regard as they are continually slowly closing the initial buy movement. Okay, they tap price there once and then twice again, and as you can see in this example, they sell down, push up price, close off at break even, and then push up price once again. Now these are rejection blocks. However, it's better to actually understand them as simply a lower time frame liquidation, and this will then be represented on your higher time frame as these two candles. One where the current candle sweeps the previous candle's low point, and this acts as your liquidation, okay, making focus of the previous candle's close point and the new candle's opening. This creates our rejection zone where price will usually return to this area and then start pushing up higher. This also incites very great movement in the market as it is based off of a liquidation. And as you can see, if you look back into our AMD models and Power 3, we can understand that this would already be an accumulation, manipulation, and distribution, which is why we see such a very fast movement from this. Okay, as you can see in this example, on your higher time frame for our price has our candle opening, but main focus is on the candle close and the new candle opening. This is our first area, and then the actual liquidation of where this happened would be at this current high point. And where does price return to? Above this point, and even entering at the equilibrium of the zone could be of great entry. As you can see, this is perfectly represented on your lower time frame as a accumulation, manipulation, and distribution. However, making focus on that area liquidation, okay, and that candle close / new candle opening, we see that price drops down but immediately comes to mitigate this area and then starts moving all the way to the downside. Another example of this: candle closes, new candle opens, major sweep, price quickly returns to this area and then continues to the upside. And as you can see on the lower time frame, sweep, candle, close, new candle opening, and then price returns to the area. Now, if you guys are still a bit confused upon this, you can also look at our previous videos on our trading every daily candle and our video on how to master the daily time frame, as we go in depth into these two liquidation models. Okay, now these are also the precise zones that you guys can also look for entry. This is actually a new found concept that I've done in my research. However, it holds great regard when you're actually trading, especially our CRT models. Now, our higher time frame CRT low gets swept. However, we then look to see price create yet another outside bar formation, as this would then regard as our candle high and candle range low both being swept. As you can see, we're making great announcement of liquidity, because this actually brings about that volume that we look to have in the market. As you can see, price will quickly in the next channel tap into this area and then just spike to the next area. And this would be our NCR or the nano CRT, okay? Right where price actually usually sweeps. Now, these are some live examples. As you can see right over here, even though we first had a candle sweep of this candle range high point and candle range low point, this then did return. However, once we had price create that outside bar formation where we saw it swept that previous candle's high and low point, we then saw a major impulse in price, okay? Even then returning again and then impulsing once again to our major draw on liquidity. Now, as you can see, here's our candle range from this high point to this low point. We then have our sweep, and then on the very next candle, we see yet another nano CRT of the previous candle's high point and low point. And then following from this, we see a massive move to the upside. Okay, now, given that you guys now have the theory and fundamentals to fully understand, it's good to also have good applications to guide you guys. And this is the exact trading checklist I use every single morning in our live trading sessions I host every single day in our Discord server, which you guys can join with the link below. And as you can see, it contains everything I look at, okay, and some better examples for you guys. Now that you guys also have this understanding, it's also good to pair it with trading it in the right market environment, which is why you guys can now watch our video on mastering one candle, where all of these are used in high regard but allow you to use them in the best areas.